Welcome everybody to the Ellsworth Advisors monthly update. Today is November 5th. The election has come and hasn't quite gone yet, so we'll discuss that, but kind of some of the ramifications of it, we're already seeing in the market, so we'll be able to dive into that a little bit. As usual, talk about some of the economic numbers, talk about how the portfolio has performed last month in October, and then there's been a shift, what's happened so far this month leading into the election and the last couple of days. So Cam, why don't you lead it off with kind of the economic highlights from October?
Sure, thank you, Kelly. We haven't gotten a ton of new economic news, but the one thing we have gotten is third quarter GDP. We expected a big rebound, we got a big rebound. So according to the Bureau of Economic Analysis, third quarter GDP increased 33.1% on an annualized basis. So let's remember where we've been. We saw a negative 5% first quarter, we saw a negative 31.4% second quarter, and now we've got a 33.1% increase in the third quarter. People got back to work, the economy started opening up again. This was a big rebound, what we call a dead cat bounce off of a very low, historic low number. Now we've had a very historic high number. If you look at the fourth quarter, according to the Atlanta Fed and their GDP Now model, they're expecting a 2.2% increase in the fourth quarter. So what's amazing about all this, and this continues whether you look at employment, whether you look at earnings, whether you look at GDP, it continues really, Kelly, to show the resiliency of the U.S. economy. We're going through the worst pandemic since the 1918 Spanish flu, and yet we saw GDP down 5%, down 30%, up 30%. If it's up, the expectations right now are 2.2%, according to the Atlanta Fed. I've seen economists at 2% to 6% for the fourth quarter. So really, if you think about it, we're going to end the year maybe down 1, 2, 3% GDP, considering the worst pandemic since the Spanish flu in 1918, which, by the way, killed 50 million people. So again, it really just does show the resiliency of the U.S. economy, the world's largest economy. It doesn't move. It's not very nimble, but it's strong, it's powerful, it covers many sectors. So while we have weak hospitality, we've got a booming tech sector, we've got booming online retail. It's just a very balanced economy, and it's kind of fascinating to go through as much pain and see really a little economic damage. That being said, obviously the elephant in the room is the election. Right now, we don't know who the next president of the United States is going to be. We don't know who's going to have control of the Senate. It looks like the Democrats are going to maintain control of the House. Is Nancy Pelosi going to be the Speaker of the House? There's so much uncertainty out there, but I think the one thing that Wall Street is focused on is that both parties, neither one has a desire really to take their foot off the gas pedal. And that means stimulus, that means spending. If we have a divided government, that means no real new tax reform. So if Joe Biden's president and everybody expects taxes to go up, we could have a Republican Senate, we could have a narrow Senate, and nothing might happen. And frankly, if you look at what's happened over the last couple of days in the stock market, that's what Wall Street wants.
I agree. The big thing is that divided government. It looks like the Senate is going to be Republican. Mm-hmm. So once again, like Cam said, okay, that eliminates a lot of the tax increases, which people were stressing about. I've had many calls from clients regarding that. What's going to happen with these tax increases? Is that going to kill everything? Republican Senate, that kind of takes that off the table because the president would need that to raise taxes, so that's good. But the other side of it, like you mentioned, is stimulus is going to be coming.
Yeah, there's going to be some.
It was probably going to be coming regardless.
Big. Yep.
And now we're going to have a pretty sizable package that's coming that will continue the upward direction. I think one of the important things that Cam mentioned was overall year over year, the GDP will probably be down 2 to 3% is kind of what it's looking like right now, depending on how the numbers shake out for fourth quarter. Fourth quarter is going to hinge on things continue as they are. We don't have a major lockdown, which I think the appetite for a major lockdown is pretty minimal.
Has fatigue at this point.
I don't think everybody's going to be up for a major lockdown. So I think the opening up and the economy will continue to improve. That's kind of the key right now, especially for the markets, because with the stock market now, it's more about direction versus the actual amount of gain or loss. It's more about the direction because right now there's no alternative to get any kind of gains except for in the stock market. Interest rates are so low that to get any kind of 1, 2, 3% interest rate, you have to go into junk bonds or high-risk bonds. Why not be in a high-quality stock paying a 2-3% dividend? Yeah. And now you have the cash flow and potential appreciation in an improving economy. So
this harkens back to when we're talking about fixed income, basically taking your money and putting it under the mattress. There's just no yield.
That's kind of how
all the money's going into equities.
Fixed income right now is basically for capital preservation and for short-term liquidity needs is how you have to look at it. Now we have to stay there to help cushion the ups and downs of the market. And that's one thing, too, that we've seen a lot of this year are these big major swings. In October, we hit new highs in September. In October, we sniffed a 10% correction. I think intraday we were probably 9.5, 9.6% to the downside, last week when things got pretty ugly. So, that's a pretty big swing. We've seen 10% swings since March. Obviously, March was a huge downside. So this volatility, I think this is here to stay for quite a while where we're going to see, big steps up, big steps back. The trend going to be probably to the upside in the short and intermediate term. And
this is very reminiscent of 99, 2000, 2008, 2009.
Correct.
I am looking forward to the days when we talk about a 50 basis point increase in the Dow, a 1% increase in the Dow, a 1% loss. I don't need to see 4, 5, 6, 8 points, 8 percentage points down in a day, but that's where we're at right now.
Yeah, and I think that those days don't come until we get through this whole cycle, and we're definitely not there yet. When that day comes, who knows? But in talking about the markets, year to date, once again, it's kind of a tale of where you're actually invested or what's working where. Year to date, the Dow is down, or through October, the Dow is down 7.14%. In October, the Dow actually went down 4.61%. So that's kind of that correction I was talking about, and a lot of that came late in October, leading into the election. The S&P year-to-date through the end of October was up 1.21%. In October, it went down 2.77%. The NASDAQ year-to-date through October is up 21%. In October, it went down 2.3%. So, it's been the tech stocks that have definitely driven the market. And, the biggest concern I have with those is obviously from a valuation standpoint. They're richly valued. You could argue they're not quite as highly valued as they were back in 99, 2000. They're quickly approaching those areas. Some strategists believe, from a market standpoint in general, we probably have another 15, 20% more to the upside, just in the short to intermediate term. And once again, that's going to take us closer to those cracking levels. That's always been our concern. That's why we stayed away from it.
The argument's always been made. Let's just take Amazon, for example. Amazon's a great company. They've built a great business model. Packages are flying around the world at Amazon. And people are like, well, they're a great company. I want to own it. But that's already priced into the stock, that they're going to continue to be a great company. So now you're looking at, do the earnings justify the value I'm paying?
Right.
Do I want to pay 3, 4, 500 times to get $1 of earnings?
Right. And the question is, can they double the amount of business they're doing now?
Right.
Is there even that much business out there? That's always the big question mark about the way these some of these stocks, the way they're going is it really feasible? Do trees grow to the sky? I remember back from a key bank analyst saying back in 1999 trees don't grow to the sky. This is going to end someday. Well, he was ultimately right. And we're kind of going on that path now. And once again, that's kind of why we've stayed away from those, because we don't like what that downside really looks like. Now, the numbers I just talked about were through October. So leading into the election, there was a lot of nervousness around, hey, if this is going to be a contested election, we're going to see total chaos in the markets, or if there's a blue wave, we're going to see massive tax increases, and that's going to crush the economy. I didn't fully buy in. Based on the way tax increases were lined out, I don't think it would have been that big of a
headline news.
Yeah, it wouldn't have been that big of an issue. I still, prior to this, I was in the camp. It really wasn't going to matter who was president. It's definitely more encouraging that we have a split government, so that's good. So you had all this fear going into last week. You had a lot of selling last week, and turn the corner come Monday, all of a sudden the market went up. Tuesday during the election, the market went up. after yesterday the market went up. So, everything that was lost the previous week has been regained. Just month to date, the Dow's up 5.08%, and the S&P was up 5.31% just in the last 4 days. Even the Russell 2000, the small cap arena, that was up 4.98%. So we've seen a big bounce back, and looking at individual counts, it's kind of like everything that was wiped out last week has brought back in the first 3 days of this week. And today, even this morning, futures are pointing up. So it looks like we have more momentum to the upside as a little bit more clarity comes to the election. So that's kind of past us now. When we look at our portfolios, the growth with income portfolio, through October it was up 4%. We did give up about two and a quarter in October. Year to date though, just in the last 3 days in that portfolio, we picked up another, roughly 3.25%. So, basically exceeded what we lost in October in the growth with income portfolio. Still our big winners in there. A couple of the tech stocks, Apple up 48%, Nvidia up 113%. Outside of the tech arena, what's worked in there, gold's up 23% year to date. Even Nike up 19%, year to date. There's some good things going on with Nike. It's been a long-term hold of ours. We always like it. In the loser column in that portfolio year to date, Cisco is still being challenged, down about 20%. Disney, obviously we know the challenges around there. That's kind of the one most affected COVID stock we have that's really, around travel. I mean, they have their online business with their movies,
which is doing well, and
that's doing well. They haven't been able to release new movies, so that's held them back. But we're still comfortable in Disney moving forward. CVS, that's also been a little bit of a challenge for us this year, down about 22%. That's gone back and forth. We've seen wild swings in CVS, actually seen some good upside pressure last couple days in CVS. So we were not really ready to cut the cord on them yet. Price potential. Through October, price potential is down 8%. In October, it dropped 4.5%. So in October, lost 4.5. Since the beginning of the month, that's up 6.7. So that's bounced back pretty well. Year to date, it's now down 2.82. Once again, more quality-oriented challenge because we don't hold the high valuation names in there, but we are seeing some nice movement. We're seeing a more rotation towards more quality-oriented balance sheets, and with the direction of where the economy is coming from a healing standpoint, I think that's definitely going to benefit that portfolio, and we have some nice momentum, at least going into this month so far. I think that's going to continue for price potential. Dividend yield year to date, through October is down 5.57%. October down 2.35%, so kind of in line with growth with income. But through the month, so far this month, it was down 2.35. Month to date, it's up 3.05. So once again, more of a general theme of your more industrial quality balance sheets, high dividend yielders, definitely, making up some ground there. Year to date down 2.8. Big winners in there this year. Should be no surprise. UPS up 38%. Obviously, their business is doing well in this environment. Eaton Corporation, an industrial, where if we were looking at Eaton a couple months ago, it would have been negative. Now that's up 12.5%. That's nice. Caterpillar up 9.5%. Alliant Energy up 3.8. One of our utilities. Utilities were a lot stronger. They've kind of pulled back a little bit as some of the economic worries have gotten past us, as the momentum's built a little bit. In the small cap space, this is an area that's really kind of started coming into its own this year, and it's also a sign that you're seeing more money going into the small cap space, and one reason you're seeing that happen is because the valuations are a lot relatively a lot cheaper. So in this, especially in our portfolio, the Russell 2000 kind of measures that space. It's really broad-based. Our portfolio, when we're talking about small caps, it's a lot. We only hold 40 stocks, so we're a lot more selective. Year to date, it was up almost just about 1% through October. In October, everything else was down actually Small caps, we were up a little bit over 1%. Since the beginning of the month, that's picked up another 5%. So year to date, we're probably running about 6% up in the small cap portfolio. In there, once again, they're small cap stocks, so you see big swings. We have Tech Target up 67%. Appian, which is a healthcare or a biotech, up 66%. Advanced Drainage up 64%. So we see some big swingers in there. Kodiak Sciences in October was up 55%. So good things going on in small cap. I think we're going to continue to see some traction in there in the small cap arena. So in general, I think we're well positioned. I probably say this every time. But once again, we're positioned where we can gain some upside, but once again, always with that eye to, at some point, valuations may matter. We have to be careful about that.
We've always talked about
exactly.
Is the focus of our portfolios is to participate on the upside and protect against the downside. And it's not sexy, but it's a time-tested model. It works. When you buy good quality companies, you're confident that they're going to be worth more in 5 years, in 10 years, and in 15 years. And that's the mantra. It works. And you got to stick to your game plan.
Yeah, I really believe we're going to see more upside into the end of the year. I think we're definitely going to see some more chop up and down, and I think the chop is going to be with us for a while.
Yeah.
And bigger swings are going to be more the norm. Which, looking back, you look at the volatility measures. Volatility has been fairly low for the last 10 years, and now all of a sudden we see all this volatility. People are more aware of it because of the ability to see pricing so much more quickly. You have a bigger media presence in the financial.
24-hour news cycle.
Yeah, you have more media attention on it, so you see the volatility. If we go back to the 90s, the volatility was this high at all times, but because you had to actually, I remember when I first started in the business, to find out what the market was, you had to, we called a phone number to get a market quote. You didn't see it nonstop.
You were a dinosaur, Kelly.
Yeah, you didn't have the cable news networks that are devoted to finance, so you weren't aware of the intraday swings. So we're kind of getting back to what the market really is, which is always going to be, without uncertainty there is no market.
Right. We
always have uncertainty. It's definitely more highlighted now. I think some of the uncertainty may fall off a little bit. Now that it looks like we're probably going to have a Democratic president, so some of the media headlines may shift a little bit, may become a little bit more
they're going to be positive now.
A little bit more optimistic, because there's definitely a slant. It depends on what you watch. That's going to give you a sense of what's going on. But the realities are things are improving, but some of the big some of the big issues are still out there. Deficit issues, just structural issues in the economy that have not been addressed. You mentioned, the recession. The recession only really, truly affected a small part of the economy when you measure from a stock market standpoint. But the reality is in a real recession, everybody's hit. And that's where, what we saw in March probably pulled forward part of a future recession. But I don't think this is like, previously, our last recession was 08, 09. We had a 10-year window. I don't think our window is 10 years for the next recession. No. It's probably going to be, at some point we will see a real recession. Yeah. And with all the stimulus, obviously it's going to be pushed back probably a couple of years.
You can only prop up an economy so long before it has to take a natural step
It's going to happen, but we've definitely bought time, and that's, in this short period of time, the intermediate term, short term, we need to stay invested. We need to be able to ride through this, at least for a while here. And that's kind of the stance that we're going to be taking.
Yeah. So thank you for your time. If you have any questions, feel free to give us a call.
Thank you.